Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for February 5th of 2023. Please see our disclaimer for important information. We get started in the chart pack this week. Two very big data points last week. One was the Fed rate decision. The other was the employment number. And so a lot of interrelatedness between those two and what's going on in the backdrop and the economy. So I'm going to be brief here. We've got several different comments on inflation. Here we've got the core services and core goods numbers kind of isolated. And so we know that core goods prices have been falling for a while. Core services have been going up. And so services, and you think about that, it includes labor costs, which have been relatively sticky. We're going to see in a second where labor costs are going down and trending in the right way, but may have a ways to go. But clearly here it's a tale of kind of two cities, so to speak. Goods inflation has given way to services inflation, which arguably is a little bit harder to beat down over time. So here's the PCE number. Again, personal consumption expenditures. PCE is what it's a inflation gauge that the Fed looks at. So it's different in its construct from the consumer price index that we see quoted in the papers, but nevertheless, it's very important. It's a proxy for inflation. Looking at this here, you can see the all-in number in gray, PCE number, core PCE is in blue. The PCE itself runs generally below levels that the CPI does, Consumer Price Index. And you can see here, things are kind of hovering around that 5% level, and but they are coming down. Again, the speculation that exists out there and where we are in this uncertainty here entering the second week of February is how fast is that going to fall, and should the Fed begin to slow down and kind of like take a pause and assess what's going on here. But again, we know that inflation is higher. It is coming down. And again, you can argue whether that's coming down in goods or, goods inflation versus services, but it is coming down. So we want to see this trend continue. Here's a 1 month change in that PC, and this shows you what I'm talking about here. So, after, a number of months here where we see that data point those monthly PCE numbers be pretty strong, we see them negative now. This is disinflationary, and we see for the first time in a little while 2 consecutive months where that's disinflationary. And I think this is very positive and powerful, and I think this helps us in that argument that yes, inflation is still on pace, and that we need to kind of see this through. Well, here's PCE excluding food and energy. So with all the positives, we've learned well enough over the last year that there are always puts and takes to everything. And so when you look at inflation and the inflation basket itself and what gets measured, we see here, excluding food and energy, that prices are not, that PCE, I should say, is still a little elevated. So we want to see this track down a little bit over time and not, have PCE not benefit primarily from food and energy, which can be pretty volatile in their own right. Well, here's central bank interest rates. We see, the Euro Central Bank, and then Bank of England, and then the Federal Reserve here. So, we know we're in that range now, 4.5 to 4.75% on Fed funds rate, and you can see, the very consistent stair stepping of these other central banks. And Europe got a little bit of a later start. Obviously, they were kind of dealing in some respects with Ukrainian invasion and some other things too, but still moving higher. What's notable in this is that everyone's moving higher, even though they're not at the same levels. But inflation rates, as we'll see in really a couple of slides here, inflation levels are not consistent across these geographies either. But here, what's interesting is that the dollar was strong for the bulk of the year last year, And we've seen some dollar weakness, and that has some positive implications for emerging markets, international investing, and certainly from commodities, from a commodity price standpoint, tend to have better performance there. And actually, too, if the dollar's weakening, then that makes our exports a little bit more attractive to overseas buyers, and so that helps our trade balance as well. But clearly, we're not going to see this reversal anytime soon in these central bank rates. So a couple of charts here that I want to point out, and we have in the black line here, this is what the market's pricing in the long-term Fed funds rate. And so when you have a period like we had last year where interest rates are moving up pretty rapidly, then you tend to see that long-term expectation move higher. But here is a case where the Fed funds rate itself has moved beyond this long-term expectation. And even though this data is predated the Fed funds announcement or the Federal Reserve announcement last week, so 4.33 here is a little dated, but it's still the circumstances still exist where you've got a Fed funds current rate that exceeds the long-term market priced expectation. And so when you get to a point like that, then the market begins to feel really strongly that the Fed is beginning to overextend and they're becoming too restrictive. And so that's where we are now. And we'll see this in the next chart too. So here we have the Fed funds rate in blue, but in black now we have the core PCE index. And we just saw that a few slides ago. We know that's coming down, but now you've got core personal consumption expenditures that are below the level of Fed funds. So a very similar dynamic that, this is kind of like inflation that's falling below this, the current policy rate. Again, this is not the CPI, this is the PCE, and CPI is typically higher than PCE, but this tells the same story that this is an indication that maybe the Fed is becoming a little too restrictive. And so I think this fuels this argument that the Fed, for its own sake, is going to have to go one more. And I think there still is a popular opinion that they could go two more quarter point increases before they stop for a while. But as we'll see in a second, market is clearly anticipating rates to go down at the end of the year. And here is that assessment right now. Market currently is betting on a decrease of a half percentage point by the end of this year. And so I want to be clear that this is absolutely at odds with what the Fed is saying right now, whether it's Chairman Powell and his post rate announcement comments in his presser, or if it's other voting members of the FOMC. They're pretty consistent that okay, they're going to get to a point of pausing, and they've talked about them being close to that point, so that's good. Now, but they're not talking about rate decreases, and so this is the market assuming that things are going to slow down, and the Fed will be inclined to want to drop a half point by the end of the year. And I think there's a pretty interesting and potentially a little volatile, disconnect here between what the Fed is expecting and what the market is. And going to that chart a few slides ago, looking at central bank activity. Now, this is the inflation backdrop in these areas. And you can see here, everybody is in this rolling over stage. U.S. is at a lower point now than Eurozone or UK. And so, again, we talked about the dollar being a little weaker. And the reason for that is that, I think there's this feeling that the U.S. is closer to pausing its interest rate increases than, say, the UK is, and they still have over 10% inflation, or the Eurozone is, and they're a little bit higher, but their economy is acting a little bit better than expected, and that so rate increases are going to continue outside of our borders where we might be, pausing for a bit, and so that's putting a little pressure on the dollar, and so this is the dynamic. But it's good to note that even though we're still at aggregate levels of higher prices, that the rate of change is now to the downside. And here's non-farm payrolls, the other big data point of the week. And we were 517,000 jobs, well above average. You can see well above the pandemic average. And really just kind of an obnoxious data point, if you want to put it mildly. And and we'll see that we'll see that this number was driven in a lot of areas that have honestly been underserved. The hospitality services sector, recreational, and kind of the discretionary spending areas that were really impacted during the pandemic continue to evolve. But we did see some positive data points coming out of even manufacturing, although manufacturing is really slowing. But it's just a very interesting data point at a time where everybody is anticipating a slowing in the labor markets, and I think we're going to get that. And I think that you'll see in a couple of charts here that it is actually underway with hiring intentions and job openings and things like that. But right now, the labor market is still pretty strong. And here's average hourly earnings, aka wages, for private sector employees on a 12-month change. And so, what we see here is that this is rolling over, and it has for a little while. Again, it's still above trend, so we still see wages higher than trend. And again, that's good for the worker. But if you still have inflation that exceeds your wage growth, then you're still at a point of negative real wage growth. And so that's where we are now. And so it feels like a downturn to a lot of employees. Even though their wages are higher, they are decelerating and they're still below the rate of inflation, both for non-managerial jobs as well as the entirety of the private sector. Here's unit labor costs. We see that in deceleration. Again, just like we saw average hourly earnings. These are, calculated differently. There's, an inclusion of benefits in terms of the compensation here in unit labor. And that's decelerating. You do like to see that. Again, not necessarily when inflation is still high, but this is good from a profitability standpoint. We're going to see a little bit later on that there are some questions about, profitability and where that is going on the part of companies later this year, and the risk that it poses on the equity markets, frankly. But on the right-hand side, we see something that we really, really like to see, and that's increased productivity. And kind of a nebulous concept, but it is linked to higher productivity is linked to lower inflation. So this helps serve as kind of an inflation fighter, at a time where we want inflation to come down. And so, productivity gains, really good to see. Labor costs going down, good for companies, not necessarily as good for workers, but nevertheless, I think showing some signs that the labor market is changing. And here's some of those areas, as I mentioned before, that benefited from that outsized employment number that we just got last week. You see accommodation, hospitality, really strong healthcare, really strong government hiring, oddly enough, pretty strong. And then down, you can read through that list. Construction, we're going to talk about construction here in a second. Really interesting. And then manufacturing, still positive, even though we know that that's slowing down. And then outside of all those sectors, then you've got temp help services. There were decidedly in the negative over the last month, but a pretty strong and broad-based jobs report overall. Here's a quick look at construction employment. And again, after a decade or so of underbuilding of residential structures, we see its influence on construction employment, which continues to move higher in a pretty linear fashion. Really good to see. Obviously not driven by commercial construction, particularly office and office warehouse and those types of things, but as we'll see here in a second, residential construction is very strong for new structures, and that has led to some pretty consistent gains in construction employment. Now, as we get closer to kind of normalizing the whole real estate and residential real estate markets, you'd expect the pace of gain in construction employment to kind of soften up a little bit. But in the meantime, I should say, construction is very important because there's a lot of second order spending that comes out of the construction environment, and it's very influential on GDP and economic growth. Here's privately owned housing units under construction. Again, like I said, after a decade plus almost 14 years now of underbuilding in these privately owned housing units, obviously you can see the trough here, following the global financial crisis, where a lot of that construction activity really just dried up. And then we've been struggling to catch up ever since. You can see this outsized move in this indicator, very strong as builders are trying to meet this accumulated backlog of interested and motivated buyers that are honestly frustrated with higher interest rates now and higher prices. But the construction environment is still fairly positive for new structures on the residential side. And on the residential side, we have mortgage rates. I love to show versions of this chart because it's important to realize the relationship between the 30-year mortgage rate and the 10-year Treasury. In fact, the mortgage rates are indexed to the 10-year Treasury. And so, as you would expect, as the 10-year Treasury goes, so do mortgage rates. And so we peaked at over 7% really just a couple months ago. And right now we're sitting about 6.1, 6.2. You hear a lot of innovative things that people are trying to do to get those things bought down. Builders are helping buyers kind of buy down the interest rate for their captive finance groups, and also with some of the relaxation and some of the Fannie Mae and Freddie Mac rules that you see people starting GoFundMe pages to help pay for mortgage points to help. It's essentially a point is a prepaid interest to help buy down an interest rate, and so a lot of interesting things going on in real estate now. Here's the labor market conversation, as we talked about, fairly strong. The job number was great, but as we see here in a few indicators where there is some softness in the margin. So on the left-hand side, we've got Challenger U.S. job cut announcements, and Challenger, they track job cuts from larger companies. So this represents kind of, I'll call it the Fortune 1000, Fortune 2000, if you will. And, that number is picking up. So again, labor market softening in those areas. You read about all these different cuts, day to day now of people that are anticipating economic slowdown, and they're trying to reposition their workforce, or at least the growth in their workforce, accordingly. And so that's very much in evidence now. So we see that, all right? And then on the right-hand side, we've got the National Federation of Independent Business hiring plans. This represents small and medium-sized business. And so you see in the red are the hiring plans, and you see where that's rolling over, all right? And then you've got the private job opening rates, and you see that rolling over, even though it's at a high level. These are all tracking in the same direction. So these three data points here are pretty convincing in the sense that we should expect labor market softness in the months ahead. And let's switch gears a little bit and talk about free cash flow margins. And so, a lot has been made over, what's going to happen in the S&P 500, the price to earnings ratio, what's going to happen to value. Well, earnings, where do earnings come from? Well, they come from sales and they come from profitability. And so a free cash flow margin is just one of the many margins that people can look at. You've got gross margins, operating margins. Well, free cash flow margins are essentially like net income plus or minus the change in the use of cash from operating activities. And so you get that number and then you divide it by sales and you get this free cash flow margin. And we can see here that basically over the last 2 decades, I mean, that's been moving higher in that orange line, right? And so, and I think in a way that is arguably unsustainable. We've been talking about the unsustainability of margins for a number of years now. And so now we're at a point where that is elevated. And you can see here that you got this little tail hook at the end that it's rolling over. And so that's very normal. It's anticipated. It's expected, right? And when you hit a new economic cycle, you would absolutely anticipate that to roll over. And that's plotted against the black line here, which is nominal GDP growth, which it has over time has gone down, as you can see. But to be clear, this is not the real GDP number. So you go back to this data series that goes back to 1966, like in many of those years up to like the mid 80s, we had pretty high inflation. So the real rate of economic growth was a lot less than what's depicted here. On the right hand side, you've got FS Investments, which they're out of Philadelphia. They do great work. It's their kind of their base case, their bull and their bear case. And I'd say this is very consistent with the other research that I've been reading in terms of just the pace of margins, right? So there are some folks that are predicting kind of a rather draconian drop in margins, and in this case, that's in the blue for FS, and that represents basically a 33% drop from about 15 to 10%. Now that's pretty dramatic. That's indicative of a fairly bleak economic scenario, and then there's on the flip side, there's the bull case that actually shows margins going up. And I just don't see that as being very viable or feasible right now. I think their base case is kind of spot on, where you get somewhere around a 12, 14, 15% drop in free cash flow margins, very consistent with what you'd expect in a changing of an economic cycle. And like I said, very consistent with what I've read elsewhere. So this is a survey by Scotiabank on where they feel or where investors feel the market's going to go. And there's a lot of explanation that's embedded in this, but I'll try to be brief and just say, there's some people that feel that the market's going to continue to go up, and that we're not going to have turbulence. I'm not in that camp. But the preponderance of respondents feel like there's a negative initial trend followed by a major rebound. Now, major is a pretty strong word, but I do think this has merit, and I think there's a reason why there's a lot of folks that are gravitating towards this because, several things. One, we know that certain elements of the economy are slowing down. Labor's strong, but we see where labor's apt to slow down here. And we can anticipate margin softening, as we just saw in that last chart. And but there's still a lot of unknowns, right? We still have higher than normal inflation. We want to get that down. It's coming down, but we don't know by how much. We don't know if the Fed is going to really stick to its knitting and say, listen, we're going to have 1 or 2 more rate increases and we're going to stop for a while. We don't know if they're actually going to do that. So there's unknowns that are causing some turbulence, which I think the volatility is going to make the equity markets a bit challenging for the first half of the year. But and I do think a slowdown will manifest, but usually the equity markets will anticipate, once you see it, there's better clarity on when that next market upcycle is going to happen. And the equity markets tend to respond to that in advance. So you see the equity markets move in many cases, even before you've exited a quote recession or a downturn. So that's why I think that bar there, the second bar, makes a lot of sense, although I might temper the use of the word major, quote unquote. But you can see that not everyone's on the same page here. Some are a little bit more despondent, feel like there's major initial downside. There's that word again. followed by a timid rebound, or that you got things that are moving sideways and mostly trending lower from here. And I think, that comes into play if, and I say with a capital I and an F, if you get inflation that doesn't come down as much as you want it to, or as fast as you want it to, or you get the real sense that the Fed becomes super frustrated that what they're doing is not working and they're going to have to keep their foot on the accelerator, or you get data points that are extremely poor, or you get, margins in the next reporting season for first quarter results, which we're going to get like in April, beginning in April and early May, where they're really bad and margins are going down and earnings expectations are falling off a cliff. I think that's what drives a sideways market and some of these other scenarios. But again, the base case now is that you have margin erosion. You have inflation continuing to come down. You have the Fed at some point pausing to see what the impact of their work is. And again, let's keep in mind too that money supply growth is like been negative month over month the last several months, and the Fed is tightening also by shrinking its balance sheet by and we've never done this before. So there's a lot of unknowns that need to be processed. So again, long story short, I'll leave this slide, but I think there is a lot of merit to a negative initial trend followed by positive activity later on this year. And here's a couple of indicators on the equity markets. First, on the left-hand side is the put-call ratio. So when the put-call ratio is low, that tends to be bullish for the market, and there's a reason for that. So these are options. Puts are a bet against the market going down, and calls are a bet for the market going up. And so if you believe the market's going to go down, well, you're damn sure going to be motivated to want to buy puts to protect yourself, to provide that insurance. Well, if you're not buying those puts, then you've got to feel, you have to feel more optimistic, and that's where people are right now. And you see that little red circle, with that the amount of put option volume relative to call option. People are much more optimistic now than they were, honestly, even just 2 months ago. And then on the right-hand side, you've got the volatility indicator. And so we call this the VIX. So this is the volatility on the S&P 500. And as it shows here, there are higher lows. So volatility has picked up over a number of years, and it does move in some vague cycles. And so, but volatility has dropped off over the last several months. And so, that is not consistent with an environment that where we're entering some kind of an economic slow period. Typically you see that volatility pick up. And if you thought that like maybe December or like November was the bottom of the market and we're establishing a kind of a new bull market, so if you felt that way, that VIX would have spiked to 50, which is that solid red line. It would have spiked. You would have had that capitulation where people are like, oh, I just can't take this anymore, and they sell everything in the market, and that's usually when you want to buy. But we never saw that. So the market, again, leaving this slide, market is, I don't want to say complacent, but they're just uniquely optimistic at this point. Here is the number of members of the S&P 500 above their 200-day moving average. And this is a technical indicator, and this is actually very positive. So you have basically 75% of the S&P 500 constituents that are trading above their longer-term moving averages, which is a pretty bullish sign. And in bulk, the S&P 500 index itself, its 50-day moving average is sliding through that 200-day, and that's usually an indicator of the market continuing to move higher. Again, this dovetails real nicely with the last chart we showed, with volatility being lower, investor sentiment being relatively bullish right now, and so that's causing stocks to move up. But I just want to caution before you start drinking the Kool-Aid. Just know that there's more volatility on the horizon. Here's a quick check-in on international sales. We've seen, as we've talked about already, some in the interest rate movements for foreign central banks, ECB and UK having higher levels of inflation, and so and where the U.S. inflation across the globe is going down, but the U.S. is viewed as being closer to that pause point than these other areas are, and so as a result, the dollar has weakened, and so that has led to kind of a bid for these international stocks. And you can see here, honestly, over the last several months, that international has really begun to kind of outperform the domestic markets. And, it's a big reason why we've kind of rotated some of that portfolio back into international, but still staying with high quality dividend payers and such. And on this chart, before I finally put a end to the comments on 2022 here, I just had to show this. It's one of the most powerful slides I think you could ever have on the fixed income markets and what happened last year. And we talked about this in our first charts of the week at the beginning of the year. Bonds defined by the Bloomberg U.S. Aggregate Bond Index were down 13% last year. That's in the red. This is a spaghetti chart showing annual returns going back into essentially the 1960s. And you can see where years, where maybe the bond market ended up negative, but never more than like 5%. And certainly back in 1994, when we had this series of rate increases, not unlike this year, but perhaps a little less pronounced, the bond market was down almost 3%. People thought that was catastrophic. And so here we are, 2022, bond market down 13%. And so anyway, I just wanted to show this to you, that it just underscores how awkward and odd and unusually bad and historically bad the bond market was last year. Well, switching gears here, we're going to stick with the fixed income markets, and a couple of things here. So we've got the 10-year to 3-month Treasury spread negative to its largest amount that we've seen in a very long time, and it continues to move lower. We're down basically, the 10-year Treasury yield is about 120 basis points, or about 1.2 percentage points below the 3-month Treasury. And so, this is telling you, the market is telling you that they anticipate that rates are going to go lower. So this goes back to that chart where, expectations that we're going to have a 50 basis point decrease by the end of this year. I mean, obviously the Fed is not talking about it, but the market believes it. And so that's manifested in this negative spread, which also is very consistent with a recession. You tend to get recessions when you see an inverted yield curve like this. Well, on the right-hand side, you've got the 2-year Treasury yield 18 months out versus the current 2-year yield. So this is kind of a forward rate compared to a current rate. And so you can see that that's negative. So absolutely, the markets are pricing in a year and a half from now that the 2-year Treasury is going to be a full percentage point lower than where it is now. So I'm going to end on a couple of things here. We've got commodity prices and supply pressures. Quick update here. We know that those are trending in the right direction. We know commodity prices have come off their peak. Although if you're buying eggs at the supermarket, you probably wouldn't agree with me. But say price pressures, you can see here, that's in the kind of the amber line. The greenish line or bluish line here represents supply shortages. Both of those are trending in the right direction. Just an update here. I'd say that shortages are maybe a little elevated from historical trends, but they're not in a bad way. And so again, commodity prices trending in the right direction, supply shortages trending in the right direction as well. And then we're going to end on this note. This is kind of a quick update on the global economic backdrop. And so you think about global manufacturing purchasing manager index. Again, manufacturing elsewhere around the world is more important than manufacturing in the US. So this is really more of a barometer of what's going on in the global backdrop. Amidst while we have this higher inflation in a lot of these major markets. So this is a diffusion index. So you see that dotted red line at 50. And so anything below 50, which is where we are now, represents contraction. So from a global standpoint, we are still in a contraction mode, even though we've had a little bit of a tick up here as of late. Interestingly enough, the International Monetary Fund and others coming out of the World Economic Forum lately have changed their tune a little bit and are raising their estimates for global GDP growth for 2023. Again, we'll have to wait and see how everything pans out, but again, we're still from a global backdrop, we're still kind of in this contraction mode for the time being. That's all we've got today. I hope you've enjoyed the chart pack. I hope you have a wonderful week, and we will talk to you again soon.